Hi, this is George. In this video, we are going to see about pair trading using spread strategy, and this is part 2 again. Like part 1 is the description is given in the link below where you can go and see the entire strategy, and this is something advanced to that. So if you want, you can just have a brief intro on that, then you can come back to this video. Or else also, if you see this video, most probably you will be able to understand this. So before getting into this video, please do subscribe to this channel if you are new here, and also please like the video finally if you genuinely like this video. And also we do have a Telegram channel. If you're interested, please go ahead and join that. So let's start. So actually, this is a hedging strategy. When I mean by hedging strategy, this is used as a hedging strategy to hedge your overall portfolio if you buy some equities or something, because this is something which will give you profit only when you are in a like kind of when market is going in the downside where your portfolio will be affected. So in that scenario, if you kind of do diligently follow this strategy every week, then you will end up in profit. If market is already in a is going upward and is in an uptrend, that is a bullish market, then hopefully you would have got that money more than this what you're going to see here in your kind of portfolio itself. So in that scenario, this will be like obviously negative thing, because as you know, hedging strategy is like when one goes profit the other goes negative, and that too, this is a hedging strategy. And in this we are again having a pair trading strategy where again we are going to implement two strategies where one will be in profit, the other will be in profit. But overall, this should be considered as a hedging strategy to your overall portfolio. So as I said, it is like a pair trading on index where we trade in Nifty and Bank Nifty. We take the opposite opinion on both. Either we say like if market goes up, then I'll be profitable in Nifty, but I'll get loss in Bank Nifty. Or if market goes down, you'll be profitable in Nifty and the vice versa. So, but in this case, we have opinion like if say suppose market goes up, then I'll be in profitable in Nifty and loss in Bank Nifty. So ideally, if we want us to be in profitable, then market has to go down. So Bank Nifty will be like giving us more profit, and in general, like Bank Nifty will be more volatile. And the way this strategy is designed is like Bank Nifty will give you more profit or loss. So whenever market goes down, as Bank Nifty is going to go up, you will be ending in profit. But if market is going up, then you will end in a loss. But your portfolio is going to go up. So entry is like as usual, like every trading setup. We entered Thursday of previous week at 9:30 a.m. and we'll exit at the expiry day at 9:30 a.m. for the current expiry. So current week it is. Then the strategy is like buying ATM call and selling OTM call, which is 200 strikes away from Nifty. Only call options we are going to execute here. And for Bank Nifty, we are going to buy ATM put and we are going to sell OTM put 600 strikes away. So this is again kind of a perfectly hedged strategy. One sell and one buy, two sell, one sell and one buy in Nifty, and one sell and one buy, one sell and one buy in Bank Nifty. In Nifty it is call and Bank it is put. And as it is perfectly hedged, the capital required is not much. It is only 45,000. And this is a summary of what we have seen. Like till December, you could have seen like we were in loss only, but in these 3 months again, you can see like the market has moved up, which resulted in more loss. So overall, we have ended in loss of 71% in this strategy. So this sounds alarming because 71% might be a very big number, but if you see overall capital, this capital record is only 45,000. So in that case, you have lost 32,000. But if suppose market has went down, if there was a panic situation, in those cases, then yes, you would have gained momentarily. So that is the ultimate aim here. So if you think if this is something you need to hedge your portfolio, you can go ahead, or else you can skip it. It's totally up to you. There will be people who have like kind of pledged your equities to sell options. In for those people, if you do this strategy, that pledged one will never go for loss if you do this strategy. So it's totally up to you again. And you can see like is it like something, this is a graph that we see for month over month, that how your PNL would have moved as per the index movement, or as per the market movement overall. So you can see like most of the weeks, 2 weeks you can see here it was in loss only, and 2 weeks it was in profit, I could say. But overall you can see like 1 week 19th Jan was like it's neutral, minus 239. But other than that, 3 weeks 2 weeks are in loss. So overall 21% loss. It's a very big loss. And the month of February, you see 2 months were like kind of no profit, no loss, and 2 months you got a good profit, which turned out to be 25% return on investment, which was very good. And March month again, you can see like it is 23% loss, where 3 months were in loss, 1 month almost 1,000 rupees profit, and the other month it was 5,800 profit. So in general, what we need to understand in these strategies are like, as I said, like when market keeps going down, you will be in profit. If market in a sense, let me show this the granular graphs for all the weekly thing where I'll be giving index movement. This is kind of a different graph which I used to show for other videos. Other videos I'll be showing how whatever the index we will be trading in only one index. So how that index is trading against your P&L and how VIX has played against your P&L. But in this strategy, we are going to see both the index movement because we are trading in both the indexes. So in general, you see like it will be like almost positively correlated. Whenever Nifty is moving up, Bank Nifty will move. Whenever Nifty is going up, this is the usual case that we see. So in that case, if you see when Bank Nifty or Nifty market in general, if it goes up, then as I said, like you will be in loss. If market goes down, you will be in loss, in profit. But on the other hand, if suppose there can be worst case scenario where Bank Nifty kind of goes up and Nifty goes down, which is like exactly what we don't want to happen. In that scenario, will be ending up in a very bigger loss. That is the worst case scenario that we'll be discussing in the upcoming slides. That is like you can see in this, like 2nd March is what that has happened. So the granular graphs, I'm not going to touch everything one by one, but I will just show you the graphs. You can just see like how the index movement has affected your P&L. I have put them in left and right, and you can see that. And in most of the cases, you can see this is a case where it was like kind of you can say it was little range bound. Maybe it started at 18,000 and Thursday we have to say 18,000. It's almost same. In that scenario again, you will be in loss because you want market to go down. That is the ideal situation for you. In this case, you can see like market has gone down from 1800 back Nifty to maybe 17,800 maybe, and Bank Nifty again 43,000 to maybe 42,000. So you have gained very good profit. So that is how this works, and this is also I would say like kind of almost a good positive correlation only, not so different. This again is a very good correlation, and because of which you can see the PNL can see in the right side. And this was a worst case scenario if I'm not wrong. Let me just go back. No, I think 2nd March or something was a very worst case. But this again is a very big loss. You can say almost 8,000 loss. And this is a scenario where you can see like Bank Nifty has actually dipped, but this dip came only after the like last day in the Wednesday, but before that we have closed. So ideally we are closing somewhere around here. If you extrapolated this, you are closing this, which is a flat. But after that, as market has went down, you're earning in profit. But or else you are going to lose this at 8,000. But as per our strategy, we are losing it. We are closing it here, so we are in the loss side. February, as we saw, it was a very good month. We can see market was in a clear downtrend. We were in profit. Market was in a maybe uptrend, and here it was like no profit, no loss. Maybe because of VIX or something else would have happened. And here again, it was like little kind of maybe neutral strategy, or it has went up and which resulted you in loss kind of. This is a very clear downtrend. You are making very good profit. So that's how it is. And this is where I said like worst case scenario, where this is what exactly I said. Nifty is coming down, Bank Nifty is going up, which is exactly which we don't want, because of which we are ending the worst case scenario here. And other than that, here you see like market is going up and down, same with the P&L. And this is a clear downtrend, we are making profit. This is almost a clear uptrend, we are losing. This is again same graph, we are losing. So this is how it is in the strategy. And in the previous strategies of part 2, I have explained like in many cases we observe like exiting on Tuesday is a better bet than Thursday. But those are like not as hedging strategy, they were like kind of a weekly income strategy. So I was recommending to close them and maybe open a new strategy. But as this is solely for your hedging their portfolio overall, so this is something that you need to hold till Thursday end. So this is not going to applicable in this case. And these 2 points is something that I already explained. If market goes down, bank market in general, which is like when Nifty and Bank Nifty both are correlated to each other, like Bank Nifty will be in profit and it will be more profit than the loss made by Nifty. So overall, you'll be earning in profit. And worst case scenario will come when Bank Nifty goes up and Nifty goes down, which was exactly happened on 2nd March. And 23rd February was the best case scenario where there was a clear downturn and we were in profit. So this is purely portfolio hedging strategy. So if you have a portfolio with more number of equity stocks and you definitely don't want market to go down, then you can do this, or else you can definitely skip this strategy. As you see, like it is 71% like kind of a decline, like ROI is negative side. So it's totally up to you to whether take it or leave it. It's not mandatory or anything, it's totally up to you. So in next video, we'll see again on another pair trading strategy, that is pending, I guess. And that is something I have to tell that I'm not actively following now. Reason being, it was like kind of I'm not able to get a liquidity which was like I think 1,400 points away. So in Bank Nifty, which was kind of odd that we are not able to get that much of liquidity. So if possible, I will be covering that. Or as I'm not doing that, I might skip that as well. So we'll see in the next week or next video whenever I'm posting. I'll give you an update on whether I'm posting it or not. Until then, bye. Thank you.